Okay, can we start?
Yes, sir.
So we will start with Basel Norms today. Basel Norms. But before that, I think we have stopped at base rate, right?
How about MCLR?
Yeah, MCLR, base rate.
MCLR.
Okay. MCLR we will discuss before that. So you can write MCLR, marginal. So we have discussed already that prime lending rate before, right? It was PLR, and RBI was allowing the banks to fix the PLR, and then there were some issues because let's say ceiling is fixed for small scale industries, and if it is the prime lending rate, that is to the best customers, let's say they are giving it at 8%, and if RBI is fixing like this PLR plus 4%, then you have to lend it at 12%. But banks were not ready, so they created another category, the best of the best category, and they created 8% for best of the best, and let's say 12% for the PLR, like that, best customers, and then it will become 12 plus 4%, that is 16%. Now because of this, actually in 2010, so PLR to base rate, right? So this was in 2010. Now this base rate is also going to be changed in 2016 to MCLR. So you can write there, or before that just write one concept, one sentence, one word here. It was actually asked in prelims before: monetary policy transmission. Just write a small heading before we write about MCLR, monetary policy transmission. Monetary policy transmission. It refers to impact of monetary policy measures, impact of monetary policy measures on real variables like production, employment, etc. in the economy. So monetary policy measures, what is the impact of monetary policy measure in production, employment, etc. So you know that, right? Just explaining that term, monetary policy transmission. For example, if repo is increasing, how will it affect the growth? There is a possibility that growth will come down because investment will come down, demand will come down. So how is it actually affecting the production? How will it affect employment? All the situations. Okay, so monetary policy transmission means how, let's suppose RBI decreasing repo, let's say 100 basis point actually decreased, then what should be the impact on other aspects like on investment and the interest rates also. Okay, so just have an idea with this word. Now let's discuss about this MCLR. You just write there, marginal cost of funds based lending rate. Marginal cost of funds based lending rate. Replaced base rate. MCLR replaced the base rate from April 1st 2016. Definition is actually same, but while calculating the rate you have to taking into consideration certain things. This is the floor rate only, or this is the benchmark rate only. Okay, and you cannot lend below this. So the same thing that we have discussed before also, it is a floor rate or the benchmark rate. Okay, and you cannot lend below this. So exactly the same things are applicable here also, but the difference is you can write the main difference. Otherwise the definition is same, the one we have discussed in case of base rate is same. The difference we write, MCLR is fixed by banks. MCLR is fixed by banks on the basis of their marginal cost of raising funds. Their marginal cost of raising funds. Okay, marginal cost of raising funds. For example, before it was average cost, now it is marginal cost. That means change is what actually consider here. So before, let's say repo rate is 10%, now repo rate is actually reduced by 8%. So this is what actually you mean by the marginal cost, the change in interest rate. So when you are considering the interest rate now, you will consider the change for the cost of raising funds. You will consider this interest rates. Okay, so the difference is if it is actually average, then banks have more discretion in fixing the interest. Banks can, adjust the average. But in case of MCLR based, banks have very less discretion in fixing the interest. So that's about MCLR. You just need to know it is about marginal cost based. It is not average cost based. Then next one, Narasimham Committee 2, not that significant, 1998. After this, we will quickly move on to Basel norms. That is more important. So 1998, you can write Narasimham Committee 2. Narasimham Committee 2. The name of the committee is Committee on Banking Sector Reforms. The Committee on Banking Sector Reforms. It is not important because most of the recommendations are actually not accepted. When we basically discuss about Narasimham Committee, or when we refer to Narasimham Committee, we basically refer to the first one. You can say recommendation 1 or 2 we can write here. Recommendation you can write, strong banks should be merged with strong banks to create few international level banks. Strong banks should be merged with strong banks to create international level banks like ICICI, HDFC, etc. It should be merged so that you can create international level banks. Second point you write, government should reduce its shareholding in PSBs, public sector banks. Government should reduce its shareholding in PSBs to 33%. So these are the two that you need to know, but this is not useful anywhere. You are not going to write in mains also. No prelims questions also will be asked. Apart from these two, the other recommendations are basically the recommendations which have not accepted in Narasimham 1. So it is a repetition. So this is not much important. Now let's discuss about Basel norms. So give a heading, Basel norms or accord or agreements. All are same, Basel norms or Basel accord or Basel agreements. Okay, so Basel norms. Just write 2 lines there. I'll show you technically how Basel norms are fixed and on what basis they are calculating and everything. I'll show you mathematical approach or mathematically I'll show calculation and everything. But just understand the basics here now. Write few lines. These are standard or prudential norms. These are standard or prudential norms for regulation of banking sector. For regulation of banking sector by the central banks. For regulation of banking sector by the central banks. These norms were drafted by the Basel Committee on Banking Supervision, BCBS, Basel Committee on Banking Supervision, under the aegis of Bank for International Settlement. Under Bank for International Settlement. So this is the international level bank, okay? So you can write under BIS. BIS was established in 1930. Bank for International Settlement established in 1930. It promotes coordination among central banks of member countries. It promotes coordination among central banks of member countries. So when we talk about RBI, RBI is the bank which is, all the banks are depending on the RBI. So same is the case here. So it promotes the coordination among central bank of member countries. So you can say this is a bank of central banks. Like RBI's case, we say bank of the bank of banks, right? Similarly, bank of central banks. RBI is a member of, BIS. So it is located in Basel. It is located in Basel, Switzerland. That's why Basel norms. Okay, now let's write about the objectives of Basel norms. So objectives: to enhance resilience of banks from economic and financial shocks. To enhance resilience of banks from economic and financial shocks. I'll tell you how is it actually going to work out, but just write this now. Second point, to enhance transparency in banking operation. To enhance transparency in banking operation.
So sorry, first point, can you please repeat, sir?
To enhance resilience of banks from economic and financial shocks. Resilience of banks from economic and financial shocks. Second point, to enhance transparency in banking operation. Transparency in banking operation. Okay, so Basel norms means these norms are actually drafted by the BCBS, Basel Committee on Banking Supervision. Okay, Basel Committee on Banking Supervision in 1988. It's right there. This were drafted by Basel Committee BCBS in 1988. So first actually in 1988, and then it was revised in 2004. Okay, so the Basel norms were actually revised to Basel II. Basel norms revised to Basel II. Okay, now in 2004 it was revised to Basel II, but still it was not able to contain that subprime crisis in 2008. Okay, there was a banking crisis in 2008, subprime crisis. I'll tell you what you mean by subprime and how it happened. Everything we will discuss in detail, how the bubble burst, everything we'll discuss. So just see here, 88 Basel norms, 2004 Basel II, but when Basel II was in operation, still this crisis happened in 2008. So you need to draft this norms or redraft this norms, right? So some more conditions has to be incorporated here. So that is why in 2010 Basel III. So we are interested in discussing about Basel III. In 2010 Basel III. Basel norms were further revised to Basel III in the context of subprime crisis of US. Okay, now one line you can write there. The focus of these norms is to ensure adequate equity or capital with the banks, adequate capital with the banks, which is measured by capital adequacy ratio, CAR. So the objective is what? Ensure adequate capital. That is what? Capital adequacy ratio, CAR, or capital to risk weighted assets ratio, capital to risk weighted assets ratio, CRAR, capital to risk weighted assets ratio. What do you mean by CAR or CRAR? I'll show you. Okay, or if you want you can write CAR, capital adequacy ratio is nothing but capital to risk weighted assets ratio. So you can write in numerator capital divided by denominator, it is the risk weighted assets, RWA. What are the risk weighted assets of banks? What do you mean by risk weighted assets? What are the assets of the banks? Main asset? Loans, right? So risk weighted assets, because loan involve risk, so we are talking about the loans.
NPAs?
Not NPA, the loans, all NPAs, all loans. All loans are assets, all loans have some risk associated with it. Okay, so capital to risk weighted assets ratio. So capital divided by risk weighted assets. So as per RBI norms, the CAR should be more than 9%. I will tell you how is it calculated and what you mean by it should be 9%, etc. Okay. Now that you can see from here, CAR is more than 9%. That means the total capital or the equity of the owners, and then if you see the loans which are given, the ratio if you take, it should be 9%. Okay. So if you need to give more loans, what you need to do? You need to infuse more capital. The reason why you need to infuse more capital, I will show you here. Okay. For example, let's say a person A established a bank. Okay, imagine the situation. This person established a bank and he invested, let's say, 1 crore. So this is the capital, this is the equity, or this is the investment. Now people deposit in this bank, and this deposit let's say it reached 100 crore. Okay, now out of this he keeps some SLR, CRR requirements, the statutory liquidity ratio, cash reserve ratio, the reserve requirements. Let's say 25% is the reserve requirements. So you have to keep this, and you can lend the balance. So you will give loan of, let's say, 75 crore. Okay, now what could be the expected profit? Let's say interest is 15%. Interest is, let's say, 15%. So what should be the expected profit here? Approximately you can get 12 crore. You can get 12 crore if you are getting interest of 15% upon this loan. So average 15%, if you calculate around 12 crore you can expect. And bank may have some cost. Okay, cost, let's say 7 crore, the establishment cost and other cost, the staff salary, the rent and everything. Now after all these costs, can I say this bank will get a profit of 5 crore? So this profit belongs to whom? This profit belongs to the person. Okay, so he invested 1 crore, and when the profit is there, let's suppose the profit is 5 crore, he is getting the entire profit. But it's okay, it is a normal situation. The person who invested, he can take the profit. But imagine a different case. If this is a loss, in case if it is going for a loss, let's say 5 crore loss is made. Now 5 crore loss is made, then what is his investment? His investment is only 1 crore. So what about the balance 4 crore? This 4 crore is actually gone from the deposits. So depositors' money will be gone. So what I'm saying is, in case of profit, the investor will get the profit, but in case of loss, the depositors will lose. Is it desirable?
No. No, sir.
Not desirable. So what we can say is, you calculate the maximum possible loss here. Let's say in this situation, the maximum possible loss may be, let's say 12 crore. Okay, let's say this is the maximum possible loss from the loan, 75 crore loan that you're going to give. So what you need to do is, to avoid the situation of losing money from depositors, you have to make sure that the maximum possible loss is 12 crore. That much money should be invested by the depositor. Then not the depositor, by the investor. That means the 12 crore is the maximum possible loss. That much capital should be there. So if more capital is there, the chances of losing money from the depositor side is less or not?
Yes, sir.
Depositors won't lose money if capital is more, right? The investor is investing some more money, so there is no chance that the bank will go bankrupt. So this is actually done for that purpose. So you have to ensure maximum capital. So that's what I mean by the objectivity is basically to maintain the adequate capital. So infuse more capital. So here we have analyzed the required capital, let's say 12 crore, on the basis of this maximum possible loss. Now if you need to give more loan, let's say he need to give 90 crore loan, then what you need to do, you have to establish how much will be the maximum loss. Based on that, you need to add more capital. So more loan if you need to give, more capital you need to infuse. You got it? More loan, more capital, also more risky loan, more capital. So this is the idea of capital adequacy ratio. Okay, I will show you one more case. I will show you. It's very technical. At this level you don't want to go. Let's say 75 crore loan. In this, let's say one section 25 crore, that is low risk loan. So this is low risk. Then 30 crore, let's say medium risk. So can you give me an example for low risk loan? Low risk.
Like loans given to government securities.
Yeah, rather than that we can say home loans, etc. Okay, so here home loans, etc. are kind of in low risky loan. Then medium risk loan, let's say 30 crore, and then another 30 crore, let's say high risk loan. High risk. Okay, so the best example of low risk is actually home, gold, etc. Okay, then high risk, can you give me an example? The small scale industries, or even car loan is also very risky loan. Why? Because car depreciate, the value depreciate, right? So car loan is also a kind of low risky loan. So you can say here 25 crore to low risk and 30 crore and again 30 crore. So you will be giving different weightage here. based on the risk. Let's say the weightage is given, it vary from 1 to 3. The weightage will vary from 1 to 3. So let's say this is 1.2 and let's say this is 1.8 and this is high risk, so let's say 2.4. So this actually vary between 1 to 3 depending on the risk. More the risk, it will be close to 3. Less the risk, it will be close to 1. So you understood how I assign the weightage. It is between 1 to 3 depending on the risk. Now this is loans, 75 crore loan that divided into this, and the risk is also given. More risk is here. So what is our formula? The formula is capital to risk weighted assets, right? Are we okay? Are you okay with this much? This we have discussed?
Yes, sir.
Yeah, what is the capital here? Capital here is 1 crore, right? The person invested 1 crore and started the bank. So, and he is lending how much? 75 crore, and that is divided like this. Now, how to write the capital to risk weighted assets here? 25 into 1.2, that is one case, plus 30 into 1.8 plus 20 into 2.4. Basically, you are finding these risks are associated. 25 you are multiplying with 1.2, 30 with this weight and 30 with this weightage. Okay, so if you do that, what you get approximately, you will get close to 0.7. You get close to 0.7. Okay, now I have already told you RBI guidelines is how much you have to keep more than 9%. So here it is how much only when you are calculating this. This is what CAR or CRAR, capital to risk weighted assets. So here in this case, the given example, it is 0.7%, but RBI says 9%. So what do you think? How much you have to add extra to keep it to 9%? If this is 1 crore, this is 0.7%. So if it is 10 crore, it will be like 7% only. So it will be approximately 13 crore, right? You need to add 13 crore to match this requirement, 9%. You got the idea? That means
Yes,
you need more capital. 13 crore should be there if you need to give loans like this. If you need to give loans like this. Now, can I give, let's say, okay, now I am ready to keep this 13 crore loan. So this we calculated for 75 crore loans, right? I'm supposed to keep 13 crore as per the RBI requirement. Now, can I increase this 75 to 80 crore? Is it possible now? After inducing after putting this 13 crore, is it possible that I can give 80 crore loan now? Is it possible?
By increasing capital, it is possible, sir.
Yeah, it is not possible with this capital. This is something which we have calculated for 75 crore loan. And if you need to, give 80 crore, what you need to do, you need to increase the capital. Because if you give 80 crore loan, what will happen? The denominator will increase. The denominator will increase means further the percentage will come down. So if you need to maintain 9%, you need to increase the capital. Similarly, okay, 13 crore itself, you are maintaining 13 crore and you are lending 75 crore. But you are changing this ratio. Like you are giving more to the risky customers. Then do you think 13 crore is enough or more you need to add? You need to add more because this is going to increase, no? So here this is 30. So if you increase this, so what I'm saying is if you are lending more loans, if you are lending more, you need to increase the capital. If you are lending more risky loans, still you need to increase the capital. So that is what you mean by capital adequacy ratio, and this is how it is actually calculated. So is the calculation part is okay for you? So if basically simply if I'm saying if I need to lend 1 crore extra, if that person need to lend 1 crore extra, he have to induce more capital. Because if 1 crore extra is added, it will be coming to the denominator. That means you satisfied the requirement of 9%. When denominator is increasing, this will actually come down. So you will violate the norms of RBI. So if 1 crore extra you need to lend, you need to add more capital so that you can remain in 9%. Similarly, if you need to lend to more risky customers, still you need to increase more capital. So the simple idea is more loan need more capital. More risky loan also need more risky or more capital. Okay, because more loan will increase the denominator, high risky loans also will increase the denominator because the weightage is changing. So in that context, you may violate from 9%, so you need to add more capital. So that is the idea of capital adequacy ratio. Done?
So how weightage is decided, or who decides the weightage?
Weightage is decided, there will be guidelines. So this loan, this particular sector will be given this much weightage. The guidelines will be there automatically. Now the capital, let's try to understand the capital. There are two types of capital. This is very important. Tier 1 capital, okay, and Tier 2 capital. So Tier 1 capital is what we call as the core capital. Tier 2 capital is the supplementary capital. Okay, so Tier 1 is the core capital, Tier 2 is the supplementary capital. So let me show you here what are the components of core capital and what are the components of supplementary capital. So let's see here Tier 1 and Tier 2. So Tier 1 capital is basically the equity capital. Okay, the investment of the shareholder or the investor, the actual investment. So I can say in this, the first component is share capital or the paid up capital. See, if you are not familiar with these words, paid up capital, share capital, etc., now you don't want to worry. You just understand these are the owner's capital, owner's investment. When we discuss about capital market, I will explain what is share capital, what is paid up capital, everything will do. Okay. Second, here will come as undistributed profit. Undistributed profit, that means reserve. So again, if you don't know undistributed profit, see, it's like this. Let's suppose bank got a profit. Let's say 10 lakh profit bank got. So from this profit, you have to pay corporate income tax. Then let's say 2 lakh is paid or 3 lakh is paid 30%. And how much is left out? 7 lakh is left out. Out of the 7 lakh, you can divide this among the shareholder. That is what distributed profit. But if you decide that, let's say 2 lakh will be reinvested in the bank, and only 5 lakh will be withdrawn and will be distributed. So this 5 lakh then will be distributed profit. This 2 lakh will be undistributed profit. And why I am adding entire Tier 1? Because this undistributed profit is coming again as the investment. So it is an investment. Okay, so that is again owner's equity only. So equity only, owner's money only. That's why similar to share capital, I can write here undistributed profit. Is that okay? So undistributed profit also comes under Tier 1 capital. Then preference share capital. Preference share, they actually have some advantages over the shareholder. Okay, we will discuss what you mean by preference shareholder, what is preference shares, etc. In capital market. A lot of different concepts need to be discussed, but here these are the three categories that we need to discuss under Tier 1 capital. So share capital, that means the owner's capital. Undistributed profit, automatically almost same. These two are almost same. And then preference share capital. Okay, they have limited claim on profit only compared to the shareholders, actual shareholders. When it comes to profit, when it comes to loss also, they have very limited claim on the loss. Okay. So we will discuss about all these later. What you mean by undistributed profit in detail, capital, paid up capital, preference shareholders, all these concepts we'll discuss later. Now, in the Tier 2 capital, subordinated debt. First one, subordinated debt. Second one, revaluation reserve. Revaluation reserve. Okay, so subordinated debt means this debt is actually having subordinated status with the normal debt. Okay, so normal debt like the actual borrowers, etc. Okay, so subordinated debt, when at that time itself they know they have secondary claim over the assets of the bank in case if there is a problem with liquidation. If the bank go bankrupt, if you see here, in case if the bank go bankrupt, whose claim will be met first? It is the debtors. Okay, and then comes subordinated debt, and then comes preference shareholders rights, and then finally is the shareholders rights. So here See here, the tier 2 capital subordinated debt will come, revaluation reserve will come. Revaluation reserve means, let's suppose in the balance sheet of the bank, the assets of the bank may be 100 crore, okay, in the balance sheet, but the actual value may be more than that. Over a period of time, it might have changed. So that's what you mean by revaluation reserve. Okay, so when you revalue that reserve, it may have some extra addition will be there. So subordinated debt means they have a subordinated status with the normal debt. Okay, so if you want, you can write one line over there. Subordinated debt during winding up of a company, the claims of such creditors follow the claims of all other creditors. In case of profit, they have more return, otherwise they have more return, so they are ready to go with this subordinated debt. Concept I'll discuss later, but just have an idea here. During winding up of a company, the claims of such creditors follow the claims of all other creditors. Okay, what I'll do is I'll explain these tier 1 and tier 2 in a balance sheet. Okay, so balance sheet means what? It is a statement of assets and liability of a company. So on one side you will see assets.
Sir, excuse me, sir.
Yeah.
Sorry to intervene, sir.
Tell me.
Sir, I just got confused whether this undisclosed reserve and undistributed profit, are they the same, sir?
Undisclosed reserve, that no, both are different. Undistributed profit means you made a profit, where I've discussed that.
Under tier 1 capital, sir.
Yeah, tier 1, yeah, undistributed, okay, that I have removed, right? So undistributed profit means actually the company made a profit. Okay, so let's say I've told you this example, company made a profit of, let's say, 10 lakh. So this is disclosed automatically. So then how can you compare it with undisclosed income or other cases? So this, for 10 lakh you disclosed and you are paying a tax of corporate income tax of, let's say, 30%, that is 30 lakh you tax paid. Then how much left out? Not 30 lakh, 3 lakh. Then 7 lakh left out. So in the 7 lakh, let's say 2 lakh you are keeping or you are reinvesting in the company, and the 5 lakh you are withdrawing. So this 5 lakh will be distributed among the shareholders, and that is what you call as dividend.
Okay.
The 7 lakh, out of the 7 lakh which is available, you will distribute only 5 lakh as the dividend. Rest of the 2 lakh will be coming back to the company, investing in the company. This is what undistributed profit. Undisclosed is different context. That is when we discuss about black money and all, we'll discuss that. Entirely different context. So this is the balance sheet of a bank. Okay, let's say deposit. Deposits is 10 crore. Okay, so borrowings. This borrowings means it can be from RBI or any other source. Okay, let's say this is 10 crore. So these are deposits is the main liability of the bank. Okay, then what is the main asset of the bank? Loans.
Loans.
Okay, so deposits, borrowing, and then subordinated debt. Subordinated debt, let's say 10 crore. Okay, then let's talk about owner's equity here. So this is the debt part, main part. Then owner's equity, that is share capital, let's say 10 crore. And then preference share, let's say 10 crore. So how much it is total? 50 crore. Okay, now liability is done. Assets, you can say some cash. Okay, because this owner's capital, this is in cash only, so some cash. And then loans, then some investments. Okay, investment means like I've told you already, GSEC, commercial paper, commercial bill, etc. Right? You remember when we discussed about first class securities, etc. We have discussed about commercial paper, commercial bill, right? Yes or no?
Yes, sir.
Yeah. So this is the investments. So all this will actually come under the asset side. Okay. So this is also, let's say, 50 crore. Now why we are writing this share capital in liability? This you may have confusion. we are writing this under liability because cash we have written here. That's why to match that we have written this as liability. So basically here the assets is not equal to liability. Assets is not equal to liability. Then how can I say this? Assets actually equal to liability plus owner's equity. That is a better way to understand in this case. Okay, so assets is not equal to liability. Otherwise, if you see liability, this is the main liability, that is only 30 crore. So why I am able to write 50 and 50? Because I am including owner's equity here. That is why I am able to write it as 50 and 50. Okay, can you hear me?
Yes, sir.
Okay, now imagine the situation. Let's say the company is shut down. Okay, now the company is shut down. Whose claim will be met first? First will be the depositors. First is depositors or the borrowings. Okay, so you have to anyway pay to the depositors and borrowers. Second, so this is the first preference. Second, you have to pay to the subordinated debt. You have to pay this one. Then third claim will be the preference shareholder. Fourth will be the shareholder. So what I'm saying is, in case of company went for liquidation, or if the company become bankrupt, you are selling the assets of the company. So the first claim will be met first of these people, then this people, then this people, and then finally if something is left out, then only shareholder. Okay, now let's say the assets is decreased to 42 crore. In this context we have discussed about how much? 50 crore, no? So 50 crore here. Let's say this assets reduced to 42 crore. Let's say it was decreased to 42 crore. That means you can see here there is a 8 crore loss. So in this context, what will happen? Who will lose the money if it is reduced to 42 crore?
Shareholder.
They will get, depositors anyway will get, borrowers will get 10 crore, subordinated debt also will get 10 crore, share capital, out of this preference shareholder also will get their claim, but the 8 crore will be lost from whose side? It will be lost from the side of the shareholders, right? So shareholder will lose here. There is no problem, bank won't go bankrupt in this context. Now if you take the next case, let's say the assets is actually decreased to 32 crore. Now tell me who all will lose money here? 32 crore, then who will lose money? Shareholder anyway will lose completely. Yes or no? Shareholder will lose completely. Okay, you can write this borrowers. Borrowers here. Shareholder will lose completely, entire 10 crore they will lose, and preferential shareholders will lose 8 crore, right? So these three people, now they are safe, they will get their money. So here in this context also, bank won't go bankrupt, no problem, not much problem. Okay, bank won't go bankrupt. Now imagine the case, this is decreased to 29 crore. The assets is decreased to 29 crore. Now what will happen? They will lose the complete. Now you start losing the debt also, right? Subordinated debt also are losing. So in this context, bank will go bankrupt. Okay, so you understood?
Yes, sir.
So you understood what I mean to say. So bank will go bankrupt, and how to avoid that? You need to add more capital. So if tier 1 capital is increased, the chance of bankruptcy could be decreased, right? So what you can do here is, what you need to do here, this you need to increase, right? Tier 1 capital you need to increase so that you can avoid the bankruptcy. So the bank won't go bankrupt if you can increase the tier 1 capital. That is the objective of Basel norms. Tier 1 capital should be increased. Now Ashwin, you understood why preference share capital is coming in tier 1? Because if it is here in tier 2, then they will also subordinated debt, if you touch it will go bankrupt. So actually it will come under tier 1 capital only, preference share capital. That is why we are saying tier 1 capital is what you need to increase so that you can prevent the bank from bankruptcy.
Understood. Yes, sir.
Okay, so in the third case, first case, okay, only share capital that will be lost. In the second case, preference share capital is lost, no problem. Only tier 1 capital, there is some problem, right? But in the third case, subordinated debt, those debt is actually decreased by, they are losing 9 crore in the third case. In that, 1 crore they are losing. So when the subordinated debt or this, the other people are losing, then there will be a problem. So tier 2 is not that significant. But then what is the need for tier 2? The role of tier 2 is basically the bank went bankrupt. Already in this context also bank went bankrupt. But you can see here who's losing the money in the context of bankrupt also. It is the the depositors are not losing, borrowings, these two's interest is actually saved, right? So can I say this, the role of subordinated debt is actually, a buffer? Like, in case if bank went bankrupt, still you can save the depositors and, this borrowing. That is the purpose of subordinated debt. Okay. So here you can see the bank went bankrupt. So whose money is lost? The subordinated debt money only is lost in this context. Not the depositors and this borrowings. They are not losing here. So subordinated debt, the role is basically to prevent the loss of money of depositors and borrowers in case if the bank go bankrupt. Now tell me, which one is more important? Preventing bank from bankruptcy or preventing the loss of money of depositors and borrowers in the context of bankruptcy? Which one is more important?
I think it's preventing the loss of money for depositors.
No, the bank should not go bankrupt. That is a broader thing. So you should prevent bank from going bankrupt. That is a broader idea and that is a broader concept. That is the reason why the stress is on increasing the tier 1 capital. So you got the idea what is coming in tier 1 capital, what is coming in tier 2 capital, and what is required. More tier 1 capital is required. So if more tier 1 capital is there, you can prevent bank from bankruptcy. Bank won't go bankrupt. And that is more important rather than once the bank went bankrupt, then you're taking care of the depositors and borrowers. Better than that, you should prevent the bank from bankrupt. Okay?
Sir, but still in the bankruptcy, there are times like a depositor will be getting only like 1 crore or 1 lakh, not more than that amount.
No, that is subordinated debt, no? They only get that 9 lakh. Depositors, normal depositors, normal the creditors, they are getting completely. They are not losing here. Subordinated debt, then they know their debt is subordinate because their return is also high. So for them it is okay. The first loss will be absorbed by the owners and the second case it is absorbed by the subordinated debt. And they know that in case of problem, it will be affected. And in that context, their return is also higher than the normal depositors.
But still we have a bar, right? Like even though you are depositing money to 5 lakh or 10 lakhs in your any bank, but if the bank goes bankrupt, you will not get the whole amount, but to a level that is 1 lakh. Right?
For whom? Subordinated debt.
That's subordinated debt? Okay. No,
subordinated debt, why it is not a subordinated debt? They know that they get very high interest and their risk is very high. They are not like normal depositors. Here the interest of normal depositors is prevented. You can see here it is actually a hedging in between. So these people act as a buffer. Okay, since during bank go bankrupt, these people will be the mostly affected. Obviously the first cases will be taken by shareholder, then preference shareholder absorb the loss. So shareholders will absorb the loss first. Initial case shareholders will absorb. It can be shareholder and the preference shareholder in the second extent. And then in case if bank go bankrupt, that will be absorbed by the subordinated debt. But what I am saying is you increase tier 1 capital so that you can avoid bank becoming bankrupt. Bank won't go bankrupt. That is more important than, you know, preventing or making a buffer. That is also required, but try to do this so that bank won't go bankrupt. Okay. Now, can we see the Basel II and Basel III norms? So Basel II and Basel III norms we'll see. So in a column, the first one, common equity. 2, tier 1 capital. 3, total capital. Okay, so I will tell you what are the changes from Basel II to Basel III. And then we will also see RBI guidelines. Okay, so everything is given as percentage of risk weighted assets. Okay, so common equity, that means the owner's capital, exactly owner's capital, that is 2%. It was actually increased to 4.5% because that should be more. And then tier 1 capital, which include the preference shares also. So total it is 4%. It is increased to 6%. Total capital 8%. That remained the same. Total capital, there is no change. Okay. So here when it was in Basel II, it was tier 1 plus tier 2 plus tier 3. There were 3 tiers before, but now only 1 and 2. You don't want to go with this tier 1, 2, 3, etc. 1, 2 you need to understand, because here I have explained what is tier 1. So the changes where you can see here, tier 1 capital, major changes there, 2% changes there. And in that itself, the actual owners, the shareholders part, also you can see the change. So what is the objective? When Basel II was in operation, still there was a crisis, right? And in that context only Basel III came. So this total capital 8% is fine, that is okay. But in that, what is better? The better will be the tier 1 capital. So more tier 1 capital should be there so that you can prevent bank from bankruptcy. If tier 1 capital reduce, then there is a chance that bank go bankrupt. Obviously, subordinated debt is there to act as a buffer, but still better to prevent the bank from bankruptcy. So this is actually increased. RBI guideline, one step ahead, 1 point you need to add, 5.5, 7, 9. So here tier 1, 2, 3 was there. In tier 3, some permanent loans will come. Anyway, that is over, so we don't want to discuss that. Here 1 and 2 only, like what I've discussed. Okay, so when I'm saying common equity 4.5, what does that mean? It actually means, so common equity divided by risk weighted assets into 100, if you do, you should be getting 4.5. Any doubt here in this? So you can see here tier 1 is increased, tier 2 actually decreased, no? So tier 1 and tier 2, you can see here tier 1 is increased means, and this total capital same means tier 2 actually decreased. So common equity increased, tier 1 increased, tier 2 decreased. That is a change. The logic is protecting bank from bankruptcy is more important than meeting the depositors once the bank become bankrupt. So broader concept is actually to protect the bank from becoming bankrupt. So that is why more focus is on tier 1 capital. So here is where you can understand that, the role of tier 1 capital. Share capital, undistributed profit, preference share. Tier 2, subordinated debt. They will absorb the loss in case of bankruptcy. So they will protect the depositors and other lenders or the other creditors during the time of bankruptcy. So increase this so that the bank won't go bankrupt. That is what you can see from this discussion. Not this discussion, this one. We have discussed that. Okay, I've removed that. So you understood, when I'm saying CE, this common equity 4.5% means what? This one. Or when I'm saying this total capital 8% means what? Tier 1, plus tier 2 capital divided by risk weighted assets into 100. If you do, you should be getting 8%. In case of India, it should be 9%. Okay, any doubts here? Okay, now you write buffers. 3 buffers are there that you can write along with this. First one, you give a heading buffers. First one, capital conservation buffer. Capital conservation buffer. Under that you can write it is maintained at 2.5%. It is maintained at 2.5% of risk weighted assets, in the form of common equity. Okay, that means actually as per the Basel III it is 4.5%, but you have to maintain 2.5% more as capital conservation buffer. So 4.5% plus 2.5%. So you can write one more line there. It can be reduced during the times of stress. It can be reduced or drawn down during the times of stress. Okay, so stress means any financial difficulty, any such situations. What you can do is you can actually stop giving dividends. Okay, no bonus to employees. So in that way actually you can increase this. Okay, because if you stop giving dividend, what does that mean? Stop dividend means what? It is actually becoming owner's investment only. So when you are not taking profit, it will be redistributed. So automatically the capital will increase. Correct, no? So automatically common equity will increase. So that is why you will stop giving dividends, bonus, etc. in the times of stress. Second concept you write, counter-cyclical buffer. Counter-cyclical buffer. It is also maintained in the form of common equity. It is also maintained in the form of common equity. It may be imposed by the central bank. It may be imposed by the central bank in the range of 0 to 2.5%. In the range of 0 to 2.5% of risk weighted assets. You can just write RWA of risk weighted assets during times of high credit growth. During times of high credit growth. So common equity, along with that you can introduce this also, right? So already I've told you the first one, that is 4.5% plus 2.5%, so that is 7. Now you can further impose 2.5%. So during this like after 2008 crisis, it was there. So high credit growth is there. You can use this counter-cyclical buffer. It is basically to counter that situation during the time of high growth. Third one, liquidity coverage ratio. Under this, banks should have high quality liquid assets. Under this, banks should have high quality liquid assets to meet cash outflow during 30 days stress period. Under this, banks should have high quality liquid assets to meet cash outflow during 30 days stress period. So if it is going like 30 days stress period will be there, means during that time banks should have high quality liquid asset to meet the outflow of cash. So cash liquidity coverage ratio, that is what you mean by liquidity coverage ratio. So liquidity coverage ratio, counter-cyclical buffer, capital conservation buffer, all these are actually asked as prelims questions in different years. Okay, so it is drafted by BIS. I have told you already, Bank for International Settlement, but it is finalized by whom? What is the major organization or agency which is finalizing all the main economic decisions relating to the entire world? G20. So it is finalized by G20, and the implementation period is 2013 to 19. Okay, implementation period is 2013 to 19. The problem is the profitability of bank will come down, because if you need to maintain all these ratios, the capital you need to increase. So you cannot lend more. So the profitability will come down. In India's case, what is the problem? I will discuss tomorrow. Now, okay, now we can stop. And you read this once, you go through what all things we have discussed. If you have any doubt, we can discuss that tomorrow.